I want to thank everybody for coming today and for coming to just talk a little bit about your financial wellness. And it's so interesting to see everyone kind of chat through the other dimensions of wellness as well. Finances, as well as all the other dimensions, they all kind of relate to each other. They touch on each other a little bit. We all know that certainly finances can be a little stressful, which is often why we have people come and see us. So with that in mind, everything we talk about today should be able to kind of touch a little bit on some of those realms, if not directly in an abstract way. I am going to ask if you have questions, please do go ahead and pop them in the chat. I am so happy to help with questions. If I don't get to it while we're chatting, I know that I'm getting some help with some questions as we go through. We have a few spots where we're going to go ahead and stop for questions as well. But if I see it and I can catch it, which is why you kind of see my eyes darting around at the moment because I'm getting my chat ready to go, I will absolutely go ahead and assist and answer it as we're going through. But for now, as was mentioned, my name is Trista Kaiser. I'm with the Office of Student Financial Services, and I do a lot of the programming for financial wellness at the university. And today we'll be talking about contributing today to protect your tomorrow. Just a brief agenda. We're going to talk a little bit about financial health as an indicator of financial wellness, some personal finance basics, just financial institutions, what assets are, liability and equity, retirement planning and investing, and then how iGrad, the university's free financial literacy platform, can help you support your financial goals. As we go through this presentation, you'll see that there's several links at the bottom of each slide, and you'll get a copy of this deck as well with those individual resources, giving you information relating to the topics that we're talking about and where you can find the information that we use to create this presentation. That's one of my favorite things about doing these presentations is I always build them as if I'm a resources. And if I can ask everybody to keep on mute, if at all possible, it would be so great. This way we can make sure everybody can hear. But those resources are really, really fantastic. They give you the capability of taking the information we talk about in this presentation today and putting it to use. So we're going to go ahead and get started. Now, when we talk about financial literacy, what that really is a path to financial wellness. More specifically, it's a set of skills that encompasses knowing when and how to find reliable information, knowing how to process financial information so that you can make sound financial decisions, and knowing how to execute financial decisions, being able to adapt as necessary to stay on track. Where when we talk about financial wellness, right, that's your actual financial well-being. The CFPB, or the Consumer Financial Protection Bureau, suggests that it's a state of being where you have control over your day-to-day or month-to-month finances. You have the capacity to absorb a financial shock. You're on track to meet your financial goals. And my favorite part, you have the financial freedom to make the choices that allow you to enjoy life. So they're very much correlated, right? We have the place where we want to go and the skills to help us get there. But beyond the skills, right, we all can learn a bunch of information. It's more than just knowing it. It's about putting it into action. So it's very important that we take these skills and use our capability to put them into action to get to a place of wellness. And we're going to be talking about that in the realm of all the different things we mentioned in the agenda today. Now, when we talk about assets, they can help us build wealth and financial security, right? Building your financial cushion through asset building helps establish financial security, which really is just the actual and your perceived understanding of how sufficient your income is to cover your expenses both today and tomorrow. It's really essential to achieving that long-term financial stability and growing your wealth, right? Having a nice little cushion to rely on as you're going through life, it makes it a lot easier for a few different reasons, right? You have a buffer for emergencies. You've got a way to plan for your goals. If you're constantly looking at your finances from a perspective where you're only utilizing what you have to spend now to make life work, you don't have that chance to build those long-term opportunities. You have more options, right? You're not fixed to just what you can potentially afford. You've got a cushion to make some different types of decisions. It also helps you earn more income. And that's on the idea of building an asset in the sense that we start with a certain value and interest grows on interest. It also inspires you to look to the future, right? The idea of meeting a long-term goal, whether it's financial or otherwise, it means that you're looking ahead, which makes it a lot easier to continue looking ahead as you build that pattern and habit. And then lastly, having a cushion and having those additional assets can really reduce your stress. As one of the points that everybody had mentioned earlier in their dimensions of well-being was physical health. Stress is not just a mental experience, it's also a physical one, right? We know that it wears on our bodies and it's very, very difficult. And finances can build into that particular component. And the last little bit of that, assets are very much an important piece of understanding what net worth is. And when we talk about assets, very, very simply, it's just something that you own that has value. And there's a couple different types that we'll talk about today. One of the things that you'll find in iGrad that can be really helpful when we're talking about asset growth, right? They have a course that's called Investing to Build Wealth, and it touches a little bit on some of the basic investment principles that go along with investing. It talks about the different types of investments and that you might find and the vehicles for utilizing them and how to protect them through things that we'll talk about today as well. So a lot of the information that we have today came directly from that course. You have access to it too, and you can refer back to it. Now, we're going to talk a bit about our financial health and the scope of net worth. And when we talk about net worth, it really is just the aggregated equity from all of your assets. When we talk about equity, that's the value, right? And assets are our things. So, net assets, everything we have, minus net liabilities, what we might owe on it, equals our net worth. A positive net worth, that's our financial cushion. It means we've got more than we need. Zero or negative means that there's no room for us to wiggle if we need to on our finances. How this plays into the dimensions of well-being in the financial wellness scale, right? The Consumer Financial Protection Bureau, as we remember, indicated there were a couple different components that go with well-being. Some of them include available opportunities, what's available to you. That goes into our perception of our well-being, right? So by having a cushion, we can certainly influence the way we perceive our well-being to be. From there, we also can see this in the concept of today's finances, right? What we have available for our immediate needs instead of maybe living in a perspective where we're only able to cover our immediate necessary expenses versus, having the opportunity to make decisions and changes and choices. And then future choices and future opportunities as well, the way that we build our money over time and what that does for us in the long run. Now, if you're in a position that you're looking to make some changes, right? We want to increase our net worth. There's two ways to do it. Either we can increase our assets or we can lower our liabilities, either up with what we have or down with what we owe. And we're going to talk a little bit more about that in the next couple of slides. So a few ways to increase your net worth, right? These are some of the specific tools that are available within iGrad to help you do that. To get to the why behind your finances, there's iGrad's money personality assessment, and that's actually something we'll talk about in a little more detail in a few slides. Um, Very simple concept: spend less than you make, buy less than you can afford, and save, right? The idea there being that the more opportunity you have to put money aside for those things that you may not, expect to have happen, or, to save for those long-term goals, it really just makes it easier to move forward. You can also look to any employer-based programs that may be available to you. iGrad has some really interesting information that comes along with HSAs or healthcare saving accounts and how you might be able to leverage that to your benefit as far as making asset growth. And they also have additional information about just general employee benefits, things that may be available to you that you weren't necessarily aware of, that could potentially reduce your spending in other areas. And then lastly, use debt responsibly. Pay down and reduce your debts where possible. You never want to be overextending yourself in any way. We know that these emergencies happen, right? But if you can get yourself to a point where you're limiting the amount of debt that you have, you're in a position where, just like money grows over time through interest on interest, so do debts, right? So the more you can limit that, the better. Now, when we talk about assets, I mentioned earlier, there's a few different types. The first is physical. Those are tangible property like a home, a car, collectibles. Their value is generally assessed on what you might resell it for, or its resale value. Financial assets are the ones that most of us think about. Those are cash, investments, retirement accounts. Those are actually valued on the value as of today from a monetary perspective. So if you were to take a snapshot of what you could potentially get from it, that's the actual worth. And then we have productive assets. Those are a really interesting type of asset. Those are the types that can help you produce more assets, and they're generally not valued in dollars. So we'll show examples of a few in a moment, but one of the most basic ones, and we all can relate to, is our education, right? That's something that we invest in that ultimately gives us value as time goes on. So that's a really great example of a productive asset. There's a couple of types of assets in the sense of liquid and illiquid as well. Liquid is those types of assets that are very easy to convert to cash. Your everyday possessions, stocks, bonds, things you can sell really quickly. Where illiquid assets are things that take a little bit more time, like a house or a car or rare items, things that deal with small markets. And then just to touch on it again, when we talk about liability, that's something you owe, usually a debt, normally money, though it could be services as well. There's a couple different types. And then equity is just the value of the asset minus the liability related to it. We hear this a lot in the concept of home ownership, right? If I have a home that's worth $500,000 and I have a $400,000 mortgage, the equity in it is $100,000. It's as simple as that. Now, one of the great things that we can borrow from the concept of business to better understand what our net worth is a balance sheet. You can create what's called a personal balance sheet to better understand what your assets and liabilities actually look like to calculate your net worth. And to do this, you want to identify and calculate all of your assets, right? You'll also do the same for the liabilities associated with them. And then you just take those assets minus liabilities. But the nice thing about putting it out this way is it's something you can rely on consistently, right? Just like the concept of budgeting, you have a document or you have a system that you start with and then you continuously monitor and adjust as necessary. You can do the exact same thing with the idea of a personal balance sheet, right? On the right-hand side of the screen, you're seeing some of the things that you might potentially utilize and include on that type of a document if you wanted to do that. But I will point out, one of the things this doesn't touch on is that productive asset category, right? This is very much just, this is worth this, and this is what I owe on it. So we're going to talk a little bit more about those productive assets in the next few slides. Now, this is where we start to talk about them, right? Calculating cost benefit. It's a personal value cost metric. And this is actually something we do every day, whether you realize it or not. If you go into a store or you're buying something online and you look at an item, you look at the price tag and go, am I going to get this? Is it worth this? That's exactly what a cost benefit analysis is. However, that's a very off the cuff kind of way of doing it. When we're in the store or again, shopping online, if you're in an environment where that's the world you live in right now, we certainly have our emotions that get attached to buying things, right? I know for me, I've been home for a little while, as many of us have. I kind of miss being out in the store in public. So, you will find yourself looking for things and just kind of, maybe you're inadvertently buying something because like, oh, I totally need that. I have to have it. It's super important to me in the moment that I'm looking at it. uh, on the other hand, we don't want to necessarily do that with some of our bigger purchases or with some of our long-term goals, right? We want to have something consistent, a metric that we can fall back on. And a cost benefit analysis will help us to do that. It factors in those direct and tangible costs and benefits, as well as those intangible benefits and potential opportunity costs, which is really just the cost or what you might have to give up to pursue a particular course of action. And again, this is really important because it provides a repeatable metric. It's not something that you're doing off the cuff. It's something that you have an established way to go back and refer to it. How we ultimately do that with a really consistent mechanism. You're going to start off by making a cost list of potential costs that are likely to arise with any potential item you're looking at that's considered a productive asset, right? Then you're going to make a benefit list, pros and cons, simple stuff, things that we know what to do with. You're going to think about those tangible and intangible benefits that can be expected. And then you just do the math. Total benefits minus total costs in purely monetary terms. You'll assign a value to it, considering the length of time that an endeavor might take to complete, the rate of future inflation and potential future interest rates, and the value of your money today and its anticipated value in the future, right? Money grows over time. And using all of that, you can get a better idea for what something is actually worth that doesn't have a monetary value attached to it. You can put these values into something called a benefit cost ration formula. It's very simply, it's just the benefit divided by the cost. And the higher the ratio, if it's higher than 1, it might demonstrate that the benefits outweigh the costs, right? It means that there's a good chance that that might be worth pursuing. Where if the cost is larger than the benefit, you might want to rethink your intended course of action because it may not ultimately give you what you're hoping to achieve over time or be as beneficial as you might think it is. So, as an example, productive asset, we'll talk about a car to start with, because not a lot of people think about a car as a productive asset, but it can be, right? It falls into the classification of a productive asset when it helps you get other assets. Okay. For example, there's the potential for an increased choice of jobs or access to medical services, right? If you're in an area where the only way to get around is using a car, certainly having one could be a benefit to you. You have the opportunity to get to somewhere that you may need to go, certainly in the case of education, childcare, and elder care as well. The other areas you might potentially see a benefit, right? Something that can grow your assets is if you're the type of person that may be doing some type of gig work, like rideshare or delivery services. I know that a lot of people don't like to think about this as an opportunity, but vehicle signage and advertising, I can share that I'm in New Jersey. So when I'm driving back and forth, up and down the parkway and the turnpike, you do see those things. And that's something that's a way to potentially build some income. Um, you also can think about it in the context of a commute where you have the opportunity to live somewhere that's a little lower cost, but still get to a place with higher income opportunities. As somebody who lives in New Jersey and typically works in Manhattan, that's something I have the opportunity to take a benefit of. But you also want to think of it in the context that cars are also reliable transportation, which falls into financial security, right? If you have a job that generally is a little difficult to get to, if you're utilizing something like mass transit, I know where I grew up, for example, I grew up in Northwest New Jersey. The closest train station was 25 minutes away. If my car wasn't working, I could not get there. And that's a problem when you're thinking about financial security in the terms of just having a job over time. But of course, there are liabilities that go with it. And that's some of what you're seeing on the bottom left-hand side of the screen. Cost value loss, they don't, keep value over time very well. Loan repayment requirements, the repercussions for non-payment, like having it repossessed and the issues with your credit that can result. And of course, repairs and maintenance over time, those other things that you have to do to keep it a reliable part of your financial security. So those are all the things that you put into that formula to get the cost benefit analysis and see if it's something that makes sense for you by assigning a monetary value to it. Education works very much the same way, right? We know that our education also gives us the opportunity for better earning potential. It gives us a chance to focus and specialize in an area. And we can use budgeting and our cost benefit analysis to better understand those financial decisions surrounding our education expenses. Do we need to go ahead and utilize maybe a one-bedroom apartment, or maybe do we want to look at a studio? Which one's better for us? And that's going to be valued differently for everybody, right? The idea of someone that may potentially need a little bit more space to be comfortable and able to focus during school, versus maybe somebody that's totally okay, maybe having a roommate. So it's a lot of different things to think about as you're going through these processes. And each evaluation is going to be a little bit different depending on who you are. Now, we talked a lot about assets, right? And some of them were financial assets. And then we need to think about, where do we ultimately keep our financial assets, right? And this is going to be why we talk about financial institutions. Financial institutions, just in general, are companies engaged in the business of financial and monetary transactions. Simple, simple, simple. But they encompass a broad range of operations within that sector, including banks, trust companies, insurance companies do fall into that classification. That's money transfer back and forth, brokerage firms, and investment dealers. So lots of different types of entities and professionals that you may encounter within the realm of financial institutions. Now, today we'll focus a little bit more in this section on banks and credit unions. And there's a key difference between the two of them we'll talk about in a few slides. But basically, they are the type of institution you think about when you're thinking traditional banking opportunities. They offer insured deposit accounts like checking and savings accounts, but they also have potentially other products and services, mortgages, loans, credit cards, retirement accounts, all sorts of different things. The big difference between the two, banks in general don't have any type of requirement necessarily in order to potentially utilize an account. They may potentially, require a certain type of amount be put into an account before you can open one, or that you have direct deposit. There's things along those lines. But the big difference with a credit union is that they're based on membership. So the idea there is they have additional establishing criteria in order to be able to utilize them. So that may influence which one you choose to pursue. Now, as far as banks in particular go, the Federal Deposit Insurance Corporation, or FDIC, insures deposit accounts in FDIC insured banks up to $250,000. This is kind of the idea of protecting your financial assets, right? We remember, many of us have heard the old adage, keeping it in the mattress, right? That's not what we really want to be doing necessarily, and this is why. Um, they actually protect your funds in the event of a crisis related to this particular institution. It covers savings and checking accounts, CDs, cashier's checks, money orders, and other official items issued by an FDIC insured bank. It does not, however, cover other items that the bank may offer that fall outside the scope of those particular things, like stocks, bonds, or mutual funds. So just because the institution is insured, it has to be the type of product that falls within the insured scope. Now, if you want to get a better understanding for what's insured and what might potentially be covered in the event of a circumstance that could lead to a loss, there's a couple different things you can utilize. On the right-hand side of the screen, the FDIC has a bank find tool. You can look for any type of FDIC insured bank within your area that you might like to utilize. They also have their electronic deposit insurance estimator, or ED. And what that does is it lets you enter your individual account information through each type of entity you're utilizing, and it'll tell you how much of that is insured. So in the event of a financial collapse with that institution, how much of your money is actually available to you in the event that they don't have it anymore. Now, the National Credit Union Administration, or NCUA, does very much the same thing for credit unions. And they actually have information on their website, including a credit union locator, if you'd like to pursue that type of institution. And if you want to take a look and get more information related to some of the protections that are associated with this, you also can look at the FATCA Act and Consumer Banking Reports. And that's information kind of like a consumer credit report, but it's specific to banks. And I'll be honest, I hadn't known about it up until very recently. I thought it was fascinating. So this is kind of interesting in the sense it's another way of understanding how to protect your money that's within a financial institution. Now, as I mentioned, right, the FDIC insures up to $250,000. So if you have more than $250,000, what are you supposed to do, right? This is where we start to talk about asset allocation and diversification, kind of mixing things up, right? Now, what asset allocation ultimately works for you is going to be very individualized. There's a few different ideas, though, to help us get a better concept for what we might choose to do. You want to think about your time horizon, which is ultimately how long it takes you to achieve the financial goal you're looking to pursue. And a kind of off the cuff method for doing that is called the Rule of 72. It's a heuristic method for calculating how long it will take to double an investment subject to compounding. It's easier than using an interest formula, but also less accurate than doing so. To do that, you just divide the number by 72, the number 72 by the compounding interest rate to find out how many periods it will take to double an investment. So whatever rate is associated with your financial asset that you've got put somewhere, the interest rate they give you attached to it, that'll give you a rough idea as to what you might earn. Now, your risk tolerance is another thing to consider. How willing are you to potentially lose some or all of your original investment in exchange for the potential for greater returns? Stocks are certainly a really common concept when we talk about that, right? We're putting money into something and we're not necessarily guaranteed to get all of it back. But at the same time, there's a chance we might get a lot more than what we initially put on. And your comfort level with that is going to be a big influence on what you choose to do. And then lastly, your unique values, your beliefs, your needs, your goals, and your circumstances, right? Your risk tolerance is directly related to your circumstances. Can you afford to be risky or can you not, depending on your individual circumstances? Now, if you're the type of person that would prefer to have something a little less off the cuff, iGrad has a really nice tool. It's called their Savings Growth Calculator. And what it does is it lets you take the initial amount of any type of investment you're looking to make. It lets you then indicate how much you plan to contribute to it over time. And it'll also ask you what type of financial institution you may potentially look to include it with. So will you be using a traditional bank, in which case maybe it's a savings or checking account or a money market account? Will you be investing it? And from there, it'll ask you how long you plan to do that for and give you an approximate value of the return. So instead of having to just kind of off the cuff with the 72 method, you have the opportunity to compare a few different ones with really, really quick information. The example on the slide that you're seeing, first on the right-hand side, it starts off with a $500 initial investment with $100 added over each month over time at an interest rate of 0.06%. And this was a rough estimate of a traditional savings account. And over 5 years, that grows to $6,510, which is great. You don't realize it up until looking at something like that, how easy $100 a month could potentially grow. Now, the same concept, if we did that looking at a 7% rate of return, and that was related to a bond or a stock, that value goes to 7,861, right? And that's the idea that you've got this potential to grow a little bit more because there is also potential risk. So this is very much just an estimate, but it's good for getting an idea for how much things may grow over time. And it's a nice alternate to the rule of 72. Now, I mentioned money personality before, right? As we go through this presentation, you'll hear me say that a lot of this really depends on you. And your personality is a big part of that, right? Risk tolerance, for example, really plays into the way we think about who we are and what we're okay with and what we're not. For that reason, iGrad actually has a really well developed tool called What's Your Money Personality? And by going through it and answering some very basic questions, just personality based questions, the way you handle certain interactions, you get about a 40-page booklet that gives you information relating to the way your personality may ultimately influence your finances. And it's not just saying, oh, you should do this, everything you're doing is wrong. It also shows you the way that you have strengths associated to your financial decision making and the way you pursue finances, in addition to some of the challenges you may face. And for me, one of the things I was told is that I can be a little bit impulsive, which I can. I mentioned me in the shopping. I'm one of those people that likes to buy. It's a thing I fight a lot. So with that being said, on the strength side of it, it shared with me that, you're not afraid to take a risk necessarily either, right? If you're impulsive, you may be willing to put that little bit more towards risk tolerance. You're not afraid to lose funding. But on the other side of it, you could potentially lose funding just by not actually stopping and thinking about what you're purchasing. So one of the recommendations they made was to slow down and take a beat. Think about it before you buy it. And I actually have done that personally. I know in this environment with online shopping, it's easy just to click in the cart and have it in 2 days, right? Simple to kind of get things immediately. Um, the way I see it, if I can wait 2 days, I can wait 4 days. So whenever I think about buying something, I'll pop it into my cart and I don't look at it again for at least 2 days. And if I still feel the same way in 2 days, maybe I'll buy it. If not, I can go ahead and take it out of my cart and I haven't lost any of the money that I would have just done if I just impulsively moved forward on making a purchase. So it's got really tangible information you can put into practice kind of in the immediacy of things, and then you can take it and contextualize it and think about it in long term. So I'm going to go ahead and take a quick peek to see if we have any questions. I don't see that any have come through in the chat, but just in case, if you have questions as we go, please do not be afraid to ask. I'm going to move forward for now, though. And we're going to talk a little bit about retirement planning and investments. We've talked a lot about growing assets, and this for a lot of people is the first place they start to do it, right? We have to think about our really big first long-term goal, which is taking care of ourselves later on in life. And this example is going to show you kind of why it's important to think about that sooner than later. A person that's hoping to accumulate about $1 million for retirement by age 60 would need to invest the following, assuming a rate of about 5% return. At 25 years old, it would be $880.21 each month. If you start doing that at 35 years old, it's about $1,679 each month. And then at 45 years old, you have to invest $3,741.27 each month to accumulate that same $1 million that the 25-year-old does, doing $880 a month, which is nearly 4 times the amount of the 25-year-old. So this is not meant to be scary. It's not a shock tactic in any way. The idea is just to articulate that if you haven't started doing it yet, now's the time to start thinking through it because it's a benefit to you to do it sooner than later. Now, if we have to go ahead and plan for retirement, how much do we need to plan to have, right? That's a really difficult question for a lot of people. So there's a few kind of general rules of thumb that you could potentially utilize. The first of which is just 80% of the salary you had while you were working. Now, with that being said, you do want to make sure you think about your individual lifestyle and obligations. If you're the type of person that currently, is planning on working in a nonprofit, let's say, and you're not necessarily thinking you'll have a whole ton of income right away, but you're thinking in retirement, you want to travel the world. 80% may not get you where you need to be. Where on the other side of that, if you're planning on a career that has a pretty, robust salary attached to it, and ultimately decide you want to retire in a cabin in Vermont, let's say, which is certainly a goal of my significant others that's shared with me. We'll talk about it more as time goes on, because I don't know that mine are exactly the same. But with that being said, he may not need 80% in order to do that, right? So the idea being you don't want to be over invested in your retirement, but you want to plan to have enough for it as well. So keeping in mind your individual goals and your circumstances in conjunction with that is very important. And in general, most people plan to withdraw about 4% of their total retirement account amount each year. So if you're retiring at 65, so just kind of keep that in mind as well. About 4% of it each year is going to be going to support yourself. And one of the really nice things that they have in iGrad, this is another course that's available. This is planning for retirement. And as I look at these, I like to point out too, there's a few different things in these courses that are really helpful. At the top right of the screen, you'll see that there's a little note that shows that this is an intermediate course. It also says it'll take about 35 minutes or so. iGrad has beginner, intermediate, and advanced course information for you to look at on several different topics. There's currently over 20 courses available. And at the end of it, you do get a booklet that's got information very much like that money personality that talks a little bit about, what you shared in the beginning of the course with a pre-assessment, how much you learned over time, and then you have information and tips on how to proceed forward. So that's a consistent mechanism you'll find within the coursework in iGrad, as well as the Your Money Personality Assessment. It's really helpful as far as your planning. Now, there's a few different types of retirement accounts that are out there. First, we'll start with 401ks, which is an employer-sponsored retirement plan. The idea being that you have a chance to contribute your pre-tax salary towards individual investment options that you choose. And there's a traditional 401k as well as a Roth 401k. With the big difference being a traditional 401k means that you're not required to pay taxes on it now. It just comes out of your pre-tax income, where a Roth 401k is something you elect to pay taxes on now rather than doing it later. And your individual circumstances will ultimately, influence how you choose to pursue that. Again, that's something that there's different types of financial planners out there that can help you with it. And we have additional information on those types of planners later on in the presentation. We also have the idea of an individual retirement account or an IRA. The big difference here is instead of it being employer-based, this is something that an individual can buy, but otherwise the concept is the same. With the traditional, again, being pre-tax, there's nothing taxed on it until you start to withdraw funds. Where the Roth, you're choosing to make retirement payments on it now as far as the taxes go. Now, 403B. This is, again, very much like a 401k. The big difference here is that it's used by qualified nonprofit companies, religious groups, school districts, and government organizations. And the benefit there is that the law allows those organizations to be exempt from certain administrative processes that apply to 401k plans. So not anything you feel right away, but the end result is that it's got lower administrative costs. And ultimately, that's something you can feel as you're going through this process. When you get a statement, you ultimately will see the amount that it costs for you to be investing in any particular retirement fund, and they're a little bit lower with a 403b. We had a question come through. If we don't spend money before 65, do we still have to pay taxes on retirement money? That's a really great question. So even if you do decide to withdraw it later on, you are still potentially paying taxes on it, depending on the type of circumstance that you have going on. One of the nice resources that we have available within this presentation has additional resources on the tax implications of withdrawing. So that should be really helpful in getting clarification depending on your individual circumstances. Now, a KEOGH plan, this is a tax-deferred pension plan, and it's available to self-employed individuals or unincorporated businesses for retirement purposes. And it can be set up as either a defined benefit or defined contribution plan. So most are defined contribution. Now, everything we've talked about so far has been a defined contribution plan. And what that means is that what you put in ultimately is going to influence what comes out, right? The money that you enter means that you're going to have income for retirement that varies based on your contributions and the way it grows over time. Where defined benefit is more what you think of in the sense of a pension plan that maybe your parents or grandparents had at some point. It's defined benefit, meaning that regardless of what goes into a plan at a certain point, there is an established amount that you are guaranteed to receive. There could be little individual nuances associated with it. Each one is going to have its own requirements and certain nuances attached to the way those funds are ultimately determined and what the defined benefit is. But each one does have something set in stone, regardless of what the initial contribution was. And then lastly, Social Security, the nation's retirement plan, if you'd like to think of it that way. It's designed to provide retirement support for workers who pay into the system. And how you ultimately do that is through your FICA taxes, or the federal insurance contributions, which is something that you'll see on your actual pay stub usually. There's a whole bunch of deductions that they list, and that's why we have our gross income versus net income. After the net, after the gross, we see all those line items. FICA is one of the line items. And the next thing is you can learn a lot more about these individual topics through iGrad's Topics Hub. So a lot of the information we talked about today is related to the information that's available there, and they have topics that are related directly to those employer-sponsored plans like the 401k, 403b, the individual retirement plans, as well as pensions. So you can visit these areas for additional information. Now, retirement accounts in concept and in most part are built on investments, right? We have the opportunity to say, all right, I'm going to retire. I'd like to go ahead and put money into investments dedicated directly for that purpose. And there's different types of investments that you could potentially see in that process, as well as in general. We also have for the first one that we'll talk about, we have cash or cash equivalents, which are kind of your play it safe investments. They're financial assets that are highly liquid and can be readily converted to cash. The most common of which is typically a checking or savings account, right? Money in, money out, really easy to do. There's little risk that they'll decline in value. However, low risk means low return, right? Interest rates on checking accounts and saving accounts can be relatively low. That example we looked at in the savings growth calculator was at 0.06%. And that is, just an average. It could be a little more, a little less. The second type that we have are fixed income assets. They're kind of your middle of the road investments, right? They offer a predictable return at a predictable time. And the idea essentially is that you're lending money to a government or company in exchange for a guaranteed return on your investment plus your original principal. The rates of return for these types of assets are a little higher than cash assets for that reason, but they're still relatively modest, and they lead to slow and steady growth. One of the first examples I encountered as a young lady of this type of investment was a certificate of deposit, or CD. And the way that those work is you have a certain amount of money that you set aside, and the bank or whatever financial institution that you're utilizing says, okay, we're holding on to this for this amount of time. You will not have access to it. But if you let us keep it, at the end, you will get this on top of it. That's the exact concept here. As long as you keep it where it's supposed to be, you'll get that particular return. With that being said, the risk comes from not having access to your money. You'll often see that financial institutions will incentivize higher amounts of money in longer terms just to give you the potential for a higher rate of return on your investment, right? So the difference between putting $100 away for a year and $5,000 away for 5 is very different. And then lastly, we have our equity assets. Those are the out on a limb type of assets. Other securities, or otherwise known as tradable assets, in which the holder has equity in a company or other account. The most common type is your traditional stock, what we think about the stock market and those types of investments. They're riskier than fixed income assets or cash equivalents because they fluctuate in value and therefore can produce variable income. And I don't know that variable really does enough to articulate it. It's not just variable in a sense that it can produce it in the positive, it can also potentially lead to the negative, as I mentioned earlier. You're not guaranteed to get back initially what you put in. So we do want to remember all investments carry some level of risk, right? No matter the type that we're looking at. You want to make sure you're carefully considering your personal investment objectives, your level of experience, and your own comfort with risk. I did want to share some additional resources on a couple different things relating to investments. First and foremost, we have information here on international investing. I know that's a question we get a lot, and there's a lot of different implications that go with it. There's also a full definition from the SEC or investor.gov, which is their website, on common investment products and their definitions. This way you understand what you're looking at with investments, which we'll also touch on very briefly today. Now, we mentioned this concept earlier, right? Allocate and diversify, and here we're going to add rebalance, okay? When we talk about our asset allocation, right, that's just dividing your investment portfolio or all those other assets that you have and everything that you've gone and went and made investments in into different categories. That's all that we're doing. Those asset categories are exactly what we just talked about, our low, medium, high risk areas, right? They're investments that have similar characteristics. Now, diversification, that's the practice of spreading money among different investments to reduce risk. The idea of being don't put all your eggs in one basket. Nobody wants to look at potentially having everything in a very, very high, high rate of return that has a lot of risk because the potential to lose all of your funding exists that way. Having a mix ensures that you're not necessarily going to, lose everything should something unexpected occur. Now, beyond just diversifying, right, it's also important to make sure that you rebalance. This is kind of akin to the idea of a budget. And I like to, or even better, let's call them spending plans, right? Budgets has a negative connotation to it. So our spending plans. When we talk about the idea of setting up a spending plan, we can't just look at it once, right? Things change over time. We change over time, our goals change over time, our needs change over time. Rebalancing does the exact same thing. It also adds the component and idea that, when we set money up in an investment, this is where we started, but what happens in the period of a year could really change. Using the asset allocation example we have on the right-hand side of the screen, you'll see that this particular person has an asset allocation built out of equity from the US as well as international. There's some fixed income things going on, some real estate, and some short-term investments. And they made the choice actively to choose about 60% or so in US equity and 28 in international equity. Now, after a year, this could go ahead and change to be almost, 70% in US equity. And then we'll see other areas either completely reduced or diminished because of the things that happened within a year in particular types of investments. It could be that, let's say, 1 year real estate did very, very well. In which case, maybe that's just an anomaly in a certain period of time. And we don't want to necessarily be that invested in that area, knowing that the common type of experience we have isn't directly related to what did happen in the last year. So by rebalancing or looking at it, you have a chance to kind of fix for anything that got out of place for what ultimately occurred. Now, the other thing that you may potentially see with investments, there's something called holdings, and that's the contents of an investment portfolio that's held by an individual or entity. So each holding could be made of several different types of asset classes, right? We'll see our low, medium, high mix in there again. But ultimately, they're generally built from a diversified set of those. Now, retirement plans in particular may offer specialized asset allocations that diversify funds based on your tolerance for risk, assuming a lower tolerance of risk as you age. So what that really means is that if I were looking at a set of holdings, right, in relation to this idea of diversification and retirement, I might potentially see a holding fund listed there that says, 2050. And that might be that maybe that's my target retirement date. And because they think that that's my target retirement date, if I were to choose that, they would set me up with this concept of, maybe I'm a little younger and okay with a little bit more risk right now. So I'll see a little bit more on the high risk categories that we talked about. And then over time, as I get closer to that 2050 date or our time horizon, it'll shift again. So that's kind of really a nice opportunity if you're the type of person that's a little uncomfortable with looking at investments, though I always encourage you to make sure you're going to ask for professional help if you need it. If you don't understand something, certainly with a retirement account in particular, those types of professionals actually give guidance on what you might choose to do on behalf of the company and for you that you're utilizing for your retirement services. Now, when we're talking about professionals, we want to talk a little bit about what a fiduciary is. A fiduciary, very simply, is someone who manages money or property for someone else, very much like that retirement example I mentioned. However, when they're named a fiduciary, that individual is required by law to manage a person's money and property for that person's benefit, not their own. So it's extraordinarily important that when you consider professionals, you're looking for one that has a designation as a fiduciary. With that in mind, there are some other implications with investing, and they'll be able to help on that front, like taxes, for example. It really just depends on the type of investment you've made. For example, the retirements, we talked about some of them being tax deferred and some not. In the individual circumstances, that can change that and when. And others might be taxed at, the time of withdrawal when you take things out, that traditional first Roth idea. Now, certain investments in retirement plans may have penalties for early withdrawal. tax or otherwise. So these types of professionals can help clarify that piece for you. And the resources, there's so many of them on the slide because it's good information. There's tax professionals listed here. There's also investment professionals. And there's a search tool through investor.gov for finding a professional that has the appropriate designation for what you're looking to get assistance with. I am going to take a quick pause. I know that we're a little short on time, so I don't want to do too much. I don't see that we have any other questions though, so I will keep going. Now, when we think about investments, so before I continue, I do see a question that pops up. Awesome. Does iGrad have information specific to international students or non-residents? That's a great question. It actually does. One of the nice things when you go on to iGrad, it may not be listed in the topics categories that are there, but there's a search feature. And if you type in the word international, it's going to bring up all of the resources associated to that particular category. So there is information there related to that. And as you're going through it, if you have questions or recommendations, if you'd like to see things change a little bit, we actually have the opportunity to give feedback to iGrad as well. So if there's something we could be asking them for that you're not seeing, go ahead and let us know. We're very, very happy to accommodate that too, but there's absolutely material there so that you can get additional information on that front. Awesome. Now, moving into housing decisions and considerations, right? Ultimately, when we think about housing, there's a two-faceted approach to it, right? There's the here and now, what we need to have happen to support ourselves, that financial security side of it. And there's what we might potentially see over time, real estate potentially as an investment, right? There's a few different things to consider. We want to think about our age, the condition of a property, what type of amenities we might want or hope to have, where the house is located, or an apartment in that instance, the neighborhood, the interest rates that you get if you're looking at a mortgage in the market, what the value is now versus what it might be later, and any improvements you might have to make. So those are kind of the long-term considerations. And the checklist that you're seeing on the screen is actually designed to help you kind of pose questions as you're going through and looking at the information, kind of getting an idea for some of the things that may be most important to you in those conversations. One of the biggest questions we get is how much can we honestly afford for housing payment, whether it's rent or not. Ultimately, an affordable housing payment is one you can reliably make each month. That's it. And only you can decide that. However, there are going to be landlords as well as mortgage lenders that will tell you that they have an idea as to what you can afford. If you're applying for a mortgage, a lot of the time you'll see an opportunity to go through what's called the pre-qualification process, at which point they tell you, oh, you've been pre-qualified for X amount in a mortgage, therefore you can afford X amount in a mortgage. Well, that's just based on their assessment of what you could be eligible for. And that is a financial institution giving you that information on an interest-bearing account. That's a debt account to you. So you always want to make sure you're using budgeting to go ahead and make that decision for yourself, looking at your own expenses and your own objectives over time. To help you do that, iGrad actually has a really nice home affordability tool, and it'll go ahead and ask you a lot of those questions. It'll ask about, what your ultimate term would be on a mortgage if you're utilizing one, as well as how much you have for a down payment, and then show you exactly how much your payment might be. It also will ask about how much debt you currently carry. So it takes in those other considerations that you might not think to include when making that decision. There's a few other ways that you might calculate that idea quickly too. For example, we have 3 methods for assessing affordability. There's one where you just take the idea of your annual gross income and times it by 3, and it's the highest purchase price of a home you might buy. Same concept of 0.3 using monthly gross income. That's about estimating monthly housing costs. However, I like the one on the bottom personally, and that's your total net income minus your total net housing expenses equals what's left for housing costs. And that's because it's very similar to the idea of budgeting, or again, spending plans. How many resources I have versus how many liabilities I have ultimately tells me what I can potentially afford. But this, again, doesn't do that cost benefit analysis, right? That's dollar for dollar. We also want to make sure we're thinking about our lifestyle, our family plans, our career path, and that's where the cost benefit analysis comes in, what this means to us in the long term on those things we can't put a dollar amount on. And these are just some of the questions, again, that you might ask yourself as you're going through this process. I'm not going to go through it in detail, but you're going to get this resource as part of the presentation, as well as a supplement to it that helps you kind of contextualize these questions as well. You do want to make sure that you're thinking about some of those other considerations that go with buying a home. For example, resale price, right? If you plan to live in your home, you want to think about that long-term value and how it impacts your financial health, since we're talking about the concept of asset building, right? Ultimately, homes in general, and in most cases, intend to increase in value over time. Depending on the neighborhood that you live in, ultimately the floor plan and property size, and then those immediate things that you may have costs for that you need to consider, like amenities or homeowners associations for pool, parking, gym, things like that, if you're looking at that type of property. On the other side of that, there's also tax implications, right? If you're going to be looking at using a home as a rental property, you may potentially want to think through some of those tax implications from a cost perspective. Where if it's your primary residence, you may see potential benefits related to your taxes. So this is where those tax information resources are going to be really helpful. And we have a whole slide with different tax resources that I'll be providing to you. I'll also be including about 11 slides on understanding the mortgage process. We didn't have the opportunity to go through it today, just because this would be way too long a presentation. But at the same time, I know it's important in making those considerations. So you'll have information on different types of mortgages and what that process looks like after we finish today as well. And then for your reference, right, this is our cost benefit analysis. Let's think about this process. And I'm going to give you guys some homework to do on your own, not to give to me, to go through the process of doing this for yourself. If you're thinking about buying a home, right, list out what you're looking for, list out what the expenses are, and then think about that long-term benefit as well as the long-term costs, and see if this is something that you might wish to pursue. Now, we talked a lot about iGrad today. There's so many tools within that platform. Ultimately, it's a free financial literacy platform that gives you just almost all of the resources you could ever need to get a good understanding of your finances. In addition to that, it also provides tools, courses, webinars. They do live webinar content as well, very much like this. And when you get into the platform, you'll ultimately start by seeing your dashboard. You answer a couple of questions, so it gets an idea for who you are. It customizes information based on the way you answer those questions and further engage with the platform. And you'll see customized, tailored content for what you need. As I mentioned, there's a search feature up at the top right. You can always look there, but that's also your centralized location for looking for the different topics, courses, and tools that you might need. And in addition to that, they have a dedicated COVID-19 hub, which is related just to information that may be most important to you as a student during the pandemic. The Department of Education also has resources available related to the pandemic, as well as University Life offers information on the events and what's going on around the campus, and also Columbia's resource guide for the community. Now, with that being said, I do want to make sure I thank everybody for participating in this today. It is so important to us that we act as good financial stewards here at the university. We take it very seriously that we prepare our students for the future. And with that being said, I do encourage anyone that has questions to please reach out to me at the contact information listed on this slide. I'm so very happy to help, but I'm going to go ahead and pass it back to my colleagues in University Life to finish us for the day.